You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. And on today's show, qualified retirement plans may reduce your spendable income, part 2 of our series on millennial tax-free retirement. All here on Let's Get Down to Business. Now I want to introduce this segment about defined contribution and defined benefit plans. If you have a defined benefit plan and defined contribution, you need to look at should you be involved in this. And the reason is because if the employer is giving you the employee is in a high tax bracket, and we're going to get into what is a high tax bracket, and if the employer's matching contributions are both, I'm into doing defined benefit or defined contribution plans. If I'm getting a match, if I'm getting some kind of bonus or incentive for my plan, especially defined contribution, I definitely want to be involved in an ERISA plan. It could be a 401k, it could be an IRA, it could be SEP IRA. Any of those plans, I want to be involved in them. And especially, again, if you're old enough to get the catch-up provision, you should be putting every dollar you can. You're going to need it. You're going to be living a lot longer than you think. Now, qualified plans, shockingly, every time I talk to most of the producers, financial advisors, RIAs, they always are shocked to find out, hey, my 401k does get a savings on my federal tax bill, but it doesn't get FICA, FUTA, SUTA. And heads up, the only ERISA plan that I'm aware of that does not only take the federal deduction, but they also get deduction from FICA, FUTA, SUTA is the 412I fully insured defined benefit plan. And by the way, that only uses whole life, guaranteed whole life. I think there's a couple indexes that have changed their chassis to accommodate it, but basically it's life insurance and guaranteed annuities. That's it. So if you're looking for something that's guaranteed and you can do some serious six-figure contributions on an annual basis, but just keep in mind, the only reason I'm bringing it up is because it's the only plan that I'm aware of that uses not only deduction for Fed, but they also get FICA, FUTA, and SUTA. I think there's a new thinking here. We've moved, and we've been talking about this now for 5-6 years, but we really need to get off the adjusted gross income. You know, hey, what's my AGI? I go down to my 1040. I look at line 31. That's my number, but it isn't. And because of different thresholds for income and deduction phase-outs and exemption phase-outs, really page 2, where we go to modified adjusted gross income, or MAGI, we really need to look at that number because that's the new number that we are all going to make our actual contributions. We're going to make our situations that we do for Social Security payouts. All that stuff is going to fall on page 2, and modified adjusted gross income now is the new play. So you need to kind of get used to page 2 and get it. And this is a good time to get with somebody that you feel comfortable with. That's a CPA, enrolled agent of the IRS, or a legal tax accountant who can kind of give you the yin and the yang and partner with them for this. This is a really good to have a really good understanding of this is part of understanding tax management, especially in retirement. Is the deduction worth it? Just keep asking yourself. It's all about mathematics. It's all about how long I'm going to live. Is the deduction I'm taking today going to be worth the taxation I'm going to have tomorrow? Every time I make a contribution into an ERISA plan, think about it. My tax bracket has to be calculated first. I have to know I'm losing basis up front. There'll be no recapture of principal. So it's really important to really get a heads-up idea. What am I doing here? And so if I wind up in the effective blended tax bracket, and I will get into that in a little bit, if you have an effective tax bracket of 20% and you're getting $1,000, you're donating $1,000 for your 401k, and you're only saving $200, if you save $200 over 40 years, is that going to be able to overcome total taxation on qualified plan and the taxation that your qualified plan actually introduces to Social Security? Because all the qualified plan monies are going to flow over to the provisional income test on Social Security, and it's going to tax it. So it's really important. Think it through. I've done my math. Is it worth the deduction? Again, if I'm in a very, very high bracket, in the 35 to 40% and more, if you're in big states like New York, Illinois, and California, hey, that may be worth it. You may want to take the deduction now and worry about converting some of that to Roth IRAs later. If you're getting a contribution, you have to take the free money. If your employer is giving you matching any part of your contribution, you got to at least make contributions up to his match. So those are the two. But remember, many of the people that are in 401ks are just not in those brackets. Now, the IRS looks at you in 4 different categories. Are you an individual taxpayer? Are you head of household? Are you actually married, filing joint return? Or are you married, filing separate? And remember, sometimes you should do your taxes both ways. If you're a married couple, sometimes I've seen anomalies where it works out, it is better to file separately. So do the math, but here's the deal. Notice that we have a marginal tax bracket. It's a progressive tax bracket. As we earn more up the tax bracket, we get taxed more on it. It's really important, at least in my thinking, to come to a place, once I identify which one of these quadrants I'm in, to see if there's any way through deductions, through exemptions, and through tax credits, can I actually move down a bracket and pay less taxes? That's my game. And I'm going to go to page 2 and look at the modified adjusted gross income to see where I fall out, and can I use the deductions? Can I use the exemptions? Is there any phase out? I want to find out what is my effective blended tax bracket so I can have a pretty good idea, is this a good deal to be in an ERISA plan? Qualified plan distributions are includable in the provisional income test for Social Security. I cannot tell you how many seminars I've done, or I get traffic from our regular consumer show, where it's a revelation to seniors that their qualified plan that they put all this money in is actually going to flow over, that income is going to flow over and is countable in the provisional income test. And the thing about that is that some people have sizable 401ks and IRAs are actually going to be bumped automatic, including their Social Security, not from Tier 1 taxation, but bump up to the max at Tier 2. This is a real critical thing. We need to start planning for taxation before we retire. And by the way, just a little heads up on Medicare. Remember, Medicare is going to go back the last 2 years of your employment, and that's your AG. They're going to look at your AGI, shockingly not Magi. They're going to look at your AGI, and they're going to say, listen, you made too much money. I think it's like $87,000 plus AGI for a married couple, and you may have to pay an IRMA surtax on your Medicare. Medicare today is about $134, but you might be paying anywhere from $200 to $300 depending upon your last 2 years. So it's really important. If you can delay, if you can defer some of this income before the last 2 years of Medicare, that could be a major play for you. The vast majority of 401k participants are not in a high effective tax bracket. So when you think about the normal tax bracket, capital gains, even with the Obamacare surcharge on capital gains, even with the hospital additional tax, 0.9 for higher people, you're looking, most people don't even know what those are because they don't pay them. So if the vast majority of 401k participants are not in an effective tax bracket, you may want to consider, why am I doing an ERISA product? Well, the only reason you would be doing a 401k or an IRA is because the vast majority of 401ks, you're getting participation with the employer. But keep in mind, if you're not getting a match and you're not in a high tax bracket, I question highly, strictly by the math. Why should I give a basis for a small tax return today and wind up having no basis at retirement and having all my qualified plans be includable in my Social Security taxation? Now, heads up, is the ERISA regulations worth it? I mean, you're going to type, yes, you can borrow from your 401k. And of course, my line is, should you do it? So penalties for taking money out of your qualified plans before 59.5 are stiff. It's ordinary income tax and 10%. And heads up, seniors. And here's another area. Advisors, I can't stress and underline more than I can right now. Most people do not know this. At age 70 and a half, if you don't pay the proper required minimum distributions, whatever you're short on, you're going to get taxed 50%. This is punitive, and it's a hassle. And you have to stay within the guidelines of ERISA 70 and a half for older Americans taking RMDs, taking constructive receipt of their qualified plan, as well as you can't take money out till 59 and a half. So remember, there's penalties here, and you need to look at it. You need to say most participants don't invest their tax savings, they spend it. Listen, when I came into the business in the 80s, we used to take the tax savings in a 401k, put it into a flexible annuity, and you'd be getting a little bit of double duty off the deduction. But nobody does that anymore. So bottom line, people are spending the difference. They're not saving the difference. Remember, it's not how much you make in retirement, it's how much you keep in retirement. So when you look at the bottom number, you have to look at not only what you're investing in, but you need to see the tax consequences to measure, is this a good deal or a bad deal? What I might be gaining short term may hurt me in the long term. For most Americans, they probably should not be participating in an ERISA product line like a 401k or an IRA, unless of course they're getting an employee match or they're in a super high tax bracket. Because remember, Bottom line, whatever my spendable money that I get to keep in my pocket is what I'm going to be able to use in retirement. And believe you me, if we're going to live as long as people say we are, we're going to need every dime we can. And we need to be thinking in terms of taxes as well as the rate of return. Don't forget to watch our next segment on HSA accounts and Roth IRAs, part 3 of our series on millennial tax-free retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the name of the game. Daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.